So what I just wanted to add in this call is that um, we are planning to increase the frequency of the interaction. Earlier, we used to do these calls on a quarterly basis, but going forward, we're going to do this on a monthly basis and share our views. And we'll also put a theme to the calls. Like, for example, today the discussion will be mostly on, are the markets fairly valued or overly valued? I mean, finally, if you see, all the conversation will come back to that only, right? What is the valuation for any investor, and specific sectors or stocks, etc. So this particular Manoj will do most of the talking. He'll cover the macros, but the theme will be pretty much on what is the impact on the markets and what are the valuation levels. And for the further calls, if you would like us to cover any particular theme, please message us, message me or Manoj, and we'll be happy to incorporate that. We'll also send a detailed note of this particular conversation as a proper 2-3 page or 4-page document, and send it to everybody. So over to you, Manoj. Please get started.
Thank you. Good evening, everyone. So just looks like yesterday we spoke and now we are again having a discussion, but I think that's how we want to take this up going forward. So we will probably do a quick roundup of the two principal economies before we get into India. So the largest economy in the world, United States, is heading for election. The two frontrunners for the top job seem to be having their own set of problems. And I really do not know what is going on into the minds of the American voter. But anyway, that is a choice that they have to make. So despite being the largest economy and a military superpower, the way things are going, the US is not inspiring confidence as a global leader. While there are many political aspects to it, one of the key aspects of US being an economic superpower is on account of the hold of the US dollar in international trade. And this I have said many times in our calls also, the US dollar is acceptable to everybody because the US dollar is acceptable to everybody. End of the day, you need money to complete your payment commitments. And therefore, what you accept as money, the criteria is that you should be able to use it to meet your commitment. So long as you feel comfortable that you will be able to pay for your imports in US dollars, you are happy to accept US dollar as for your exports. And that has been one of the main reasons why the US has become an economic superpower. Now, a little more into what exactly happens when, let us say, a company like Infosys or any other exporter exports goods or services and receives money in USD. It's not like, one suitcase of US dollars is actually handed over to somebody in Infosys and that guy takes that money and keeps it in his bank or in his cash drawer. Typically, this money, let's say country X supplies goods to country Y and gets paid in USD. So these dollars do not leave the shores of America. This money is not brought back into country X. Instead, what that country X or its central bank does is that it holds these dollars in the form of US Treasury instruments. Just like, let's say we receive money for the work that we've done. We don't hold that in cash. We will put it in a bank account or we'll invest in some mutual fund or some fixed deposit or some equity share. Similarly, the country which receives the US dollars will actually buy US Treasury instruments, whether it's Treasury bills, Treasury notes, or Treasury bonds. And typically, these instruments have very, very negligible interest because interest rates in the US are quite low. Now they have gone up, but typically the interest rates are quite low. And this is what constitutes a major chunk of what we call as foreign exchange reserves. So a country feels comfortable when it has got large forex reserves because it can pay for whatever it wants. So it imports certain things, it has to make the payment. If it has got adequate forex reserves, it can make use of those forex reserves to pay for its imports. Now, post-Russia-Ukraine war, there was a significant development. The United States decided to confiscate the dollar reserves of Russia. In a bid to support Ukraine, the US said that, okay, whatever forex reserves of Russia are held in the form of US dollars, Russia cannot use them. Now, this is something which is very uncomfortable to whoever is the holder of that instrument. Imagine our demonetization scenario. Till demonetization, we were very comfortable that our money in the bank can be withdrawn at any point in time and used for whatever purpose, no questions asked. Suddenly, the government says, no, you cannot withdraw cash. And that puts a lot of control on you in terms of how you can behave. So similarly, any sovereign nation would not like its forex reserves to be confiscated just because it is being held in US dollars. So what we have seen is that the central banks are looking at alternatives to hold their forex. So now, over the last couple of years since the war started particularly, we've seen bilateral trades increasing between countries with settlement in non-US currency. Typically, the settlement is done in the currency of exporter. So if India exports, say, wheat to Russia, instead of asking for payment in money, in US dollars, it will say, okay, give me in Indian rupees. Now, similarly, if India is importing oil from Russia, Russia may say, okay, give me the payment in rubles. Alternatively, both of them may agree on one currency, either rubles or rupees, knowing fully well that it is like a barter system. So you don't need US dollars for settlement of this currency. This is done through some Vostro accounts, but we will not go into technical things. So long as my exports and imports to a particular country are more or less the same, not very divergent, the country can afford to not have US dollar as its settlement currency. China, for a few years, has been pushing yuan as an alternative to the dollar. It says, why don't you represent your trades in Chinese yuan instead of US dollar? India also aspires to increase the acceptability of Indian rupee, particularly through its digital payment forays. In spite of all this, we see that the US dollar is largely used as a currency. And this is essentially to counter the risks. You don't want to hold currency that you cannot use. Assume a country agrees to accept rupees, Indian rupees, for its imports, and tomorrow suddenly, for some reason, Indian rupee is no longer acceptable, then you're stuck with that money. It's like having a torn 100 rupee note in your pocket. Nobody is accepting. So for that reason, many traders still prefer to have the US dollar as its settlement currency. Now, what central banks are doing is to avoid these risks, they are choosing gold as an alternative. So if you noticed, more and more central banks are stocking up on gold, which has also resulted in a steep increase in the price of gold. So between, say, March 2021, gold was about $1,681. Today it is close to $2,412. So a near 50% increase in gold prices in the last 15 months. In addition, if you see, the US is not able to keep interest rates lower. It's been struggling to cut interest rates, but it has not been able to do it. The Fed is literally desperate to look for reasons that can support a rate cut. Now, one side effect is, if the Fed really manages to do that, if it manages to cut interest rates, that will further aid the increase in gold prices. But that apart, the main reason why the US is not able to bring down its interest rates is because of inflation. Today, in the US, inflation is a real concern. Now, some relief, the latest data, inflation numbers are down to 3%. But the average American is not very happy with what she needs to pay for her necessities. So the US does appear to be heading for some serious economic crisis. While this is the story on one side, if you look at the US markets, they are at all-time highs. So the Dow Jones Industrial Average has now touched 40,000. And today, about 70% of global market cap is coming from US companies. So this is a bit of an anomaly. So what is likely post-elections, the elected government will need to think of ways they can tame inflation and support growth. And this is not an easy challenge. Markets run on liquidity, which is again driven by sentiments or expectations. So it is very likely that we will see a massive correction in US markets post-election. So whichever government comes into power, whoever is the president, some tough choices need to be taken up, and that can probably impact the US markets. Coming to the next largest economy, China. China is facing its own set of challenges. Unemployment is on the rise.
Manoj, can you hear me?
Yeah.
Before you move to China, just wanted to make a couple of observations here. If you see the trend in terms of the purchases of US Treasury bills by other countries, post 2021, there's been a significant fall. Okay, so if I were to let me just share my screen for a minute, just so that this brings the point a bit more. Yeah. So this is, the red line is basically the net purchases of US Treasury bills. It is, there's been a significant, so I've used ChatGPT to generate some based on some numbers. So this is just a screen share of that. The red line is the US Treasury bills, and the blue line is the gold purchases. So there's been a kind of a cliff kind of a thing here. So do you think that we are soon approaching an inflection point where these trends will culminate and US dollar could see a significant beating in the next 2, 3, 4 years, or it's difficult to speculate?
Based on economic theory, yes, the world has been searching for an alternative to the US dollar. It has not found any currency for that. So it is going back to the original currency, which is gold. So, but gold will have its own set of challenges. But now with the digitalization and, ability to hold gold in digital form, maybe we will see gold being used as an alternative currency far more than what we had seen earlier. So this trend is likely to continue. is what I feel, and that can potentially prick the US stock market bubble also. With the
Speaking of
decline in
that,
the
yeah. So speaking of that, again, you rightly said that US is today 70% of the global market cap, which is it's a ridiculous number actually. The last time we saw such a aberration was Japan at 48% of global GDP, when it crashed and, it went all the way from 48 to 12%. So the concern is that the current liquidity boom is significantly pushing out the US stock markets. You know, S&P has grown 2.5 times, in this current liquidity boom, since 2010, post the GFC. So, so if so, what are the implications on the Indian investors if, let's say, there were a significant correction in the US market?
we will come to that. We'll just finish off China and then come
Sure,
to Mera Bharat Mahan. Okay, so so as I said, China is having its own set of problems. Consumption is down, unemployment is on the rise, and the real estate sector is in serious trouble. In addition, China has actually picked up fights with almost everybody. It's at loggerheads with the US, European Union, Japan, Philippines, India, with only Russia being its friend and ally as of now. So clearly, this is holding back foreign investment in China. So the Chinese leadership, their Communist Party's leaders are actually having a meeting from Monday, 15 July, to come up with some tangible solutions to the economic situation. See, one can never write off China. Okay, China has always been very swift in terms of changing its strategy so that it continues to support its growth. And that's the reason why for a very long period, China had double-digit growth rates. Okay, and today in China, both interest rates as well as inflation are very low. In fact, we talk about a deflation in China, which is a situation of falling prices with slow growth. Stock markets are flat. Okay, so we do not know. Maybe China will search for and come up with a new driver of growth, which it has done over various points in time. But as of now, it does not seem to be an investor's favorite. There is serious trust deficit when it comes to China. Their numbers are not reliable. And therefore, it will take time for China to, while it can recover economic, in terms of macro parameters, it will still take time for them to gain global investor confidence, is what I think. Now coming to India, now we've been stating this for quite some time, and I'm repeating that. So India has been reporting very impressive numbers across various macro indicators. We all know it is the fastest growing major economy, and we're expected to become the third largest economy before the end of this decade. Inflation remains within RBI's window of comfort. So RBI has kept that 4 to 6% range, and we are kind of okay with that. But the good thing is that the RBI is very, very cautious, and there's always an eye on what is happening, and it is not in a hurry to cut interest rates despite the temptation to do it. So we may or may not see cut in interest rates, particularly with increase, with growth rates high. The incentive to cut interest rates is slightly less. But then if you want to attain a double-digit growth rate, you want to give further fillip to growth, then there is a case for cut in interest rates. whatever it is fair to say that we are unlikely to see more rate hikes in the near future. Current account deficit is just about 1.2% of GDP. Corporate profit to GDP is again at an all-time high, which is a very good positive. Capital formation is going strong, with the central government committed to enhancing infrastructure and increasing its capital spend. So unlike what we said regarding US consumer, Indian consumer is far more upbeat and also a little more aspirational. Now, for example, today, somebody who is planning to buy a car, earlier, maybe that person would walk into a Maruti showroom and look for a entry-level small car. But today, the same person is considering a used SUV instead of a new small car. So what it tells us about is that the consumer is willing to think big, spend more, and enhance his or her own lifestyle. Access to credit has improved. So we see credit growth rates being quite high, lot of microfinance being available. So credit is reaching to the lower strata of the economy. And while that is happening, the good part is that the RBI is very vigilant about leverage funded growth and has always kept an eye and keeps tab on runaway increase in credit. So while credit is important for growth and RBI is supporting the initiative, at the same time, it does not want our banks to go astray and go on a binge of giving loans that can have potential problems in the future. Now, this is again reflected in how major stock market indices have been moving. And that is probably what is our topic or theme of our discussion today. The question is, are the markets overvalued? Now, again, I have said this multiple times, valuation, just like beauty, lies in the eyes of the beholder. So, something which you may find as very cheap or reasonable, somebody else may find it very expensive, and vice versa. But let's try and put some numbers, some basic numbers, and see where we are headed. So we will take the most commonly followed index, which is the Nifty 50. On 4th June, when the markets crashed, the Nifty closed at around 21,884. Last time we met on 21st of June, it had already recovered and it was at 23,501. And yesterday it closed at 24,500. That means between 21st June to 12th July, just about 20 days, the index has gained about 1,000 points. Let us now look at, again, we have taken the most basic index. Let us take the most basic of all valuation parameters, the price earnings ratio. So P multiple of Nifty on 4th June was 20.81. On 21st of June, when we met last, it was 22.34. And yesterday, as per yesterday's numbers, it is standing at 23.32. The highest P that Nifty has touched was on 8th February 2021, where it clicked, the P was recorded as 41.8. The next highest number that we see as per the Nifty chart was on 13th of January 2020, when Nifty was at 28.64. And after that, maybe 31st of December 2007, that was many, many years ago, P was 27.8. On 15th of March 2021, Nifty was 14,773 with a P of 40.24. At that time, the earnings per share for the Nifty was 367 rupees. Taking yesterday's numbers, Nifty has scaled to 24,500, but the EPS has nearly tripled to 1,051. As a result, the P stands at just 23.32. So if you look at the numbers, again, just taking a clear 1 year picture, on 13th of July 2023, exactly 1 year ago, Nifty was about 19,400, P of 22.58, EPS of 858. Today, EPS is at 1,051, which is an increase of 22.5%. Nifty is up 26%, and P is largely around the same levels. So if you go back 1 year and on 13th of July 2023, when you see Nifty at 19,400, it was again near all-time highs. And there was this apprehension that markets are overvalued and markets are likely to crash because we were in uncharted territory. 1 year later, we are exactly at more or less the same levels, facing the same questions. When gold was, say, 1,000 rupees per gram, rupees 5,000 per gram looked unimaginable. When Sensex was at 4,000, 40,000 looked impossible. Today, when Nifty is at 24,500, if somebody says Nifty will touch 50,000, it looks ridiculous. But simple mathematics, if our earnings grow at a conservative 15% and P remains at similar levels, then Nifty will touch 50K in less than 6 years' time. So what I am trying to drive at is that when we look at the index in absolute terms, it is in uncharted territory. It is making new highs, and therefore it does give this fear of reaching, the dizzying heights that we talk of. The fall is imminent. We've reached too far high. This is not supported, and there's likelihood of a crash. That possibility is still there. The markets are going to be volatile and they'll have their usual ups and downs. But addressing this question of whether markets are really overvalued, overheated, etc., then if you look at history, the numbers earlier, then you don't see that these numbers are something very, very, which are difficult to maintain and that a crash is imminent. We are, as I said, just compared it with 1 year back data, we are more or less the same. The rise in the index is reflecting the rise in corporate earnings. And so long as we feel confident of earnings continuing to grow, continuing to be good, then the absolute level of the index should not worry us.
Manoj, Sorry to interrupt. I just wanted to share a chart here, similar to what I did earlier. Very interesting. So this is from Morgan Stanley. The earnings cumulative annual growth rate for BSE 500 companies from 2005 to 14 was around 17%, and then from 15 to 24 was 12.5%. But very interestingly, when you said that Nifty may touch, again, we are not trying to forward look, but just assuming a 15-16% CAGR of earnings, you said it will touch, Nifty may touch 50,000 in 6 years. But the Morgan Stanley number for the next 4 years of growth, earnings growth, is it's a mind-boggling 22%. So imagine where it will be or how soon that could be reached. And in context, where are we today? So just wanted to share this actual number. I mean, the number that came from the Morgan Stanley guys. And if you look at other charts, like our global exports are growing significantly, infrastructure spending is up, etc., etc. Current account balance is improving, right? Inflation year on year, has stabilized, and GDP year. These are numbers that we have. Yeah, continue, Manoj, please. Yeah.
So while I was being a little conservative, but Morgan Stanley probably is far more upbeat than me. But irrespective of that, as I said, we will have ups and downs. Almost every 2 or 3 days, we have some announcement coming up. Exactly 10 days from now, the first budget of Modi 3.0 will be presented by Finance Minister. As it is, there's a lot of talk of what the FM needs to do. Each one of us become Finance Minister and start making statements about what is best for the economy. So statements such as interest on bank deposits should be made tax-free because deposit rates have come down, and without deposit, credit growth will not happen. Credit growth ke liye we need deposits. Then cut down on the rate of capital gains. That's a direct benefit for the investors. Increase in exemption limits of taxation up to 10 lakhs, make it tax-free. All these are, there's a lot of noise in the market, usually provided by over-enthusiastic media personnel. So they'll take interviews of eminent people and they'll see what is the most impactful statement and they'll make it a highlight and print. Now, it will be great if these ideas are implemented. Obviously, the government is also thinking along these lines, what best it can do. And any of these measures that I talked of as an example will mean more money in the hands of the consumer. So, which will either result in more consumption or more investment. As long as we don't have runaway inflation, this is good news for the market. But the government will have its own compulsions. Not every wish can be included, which means there will be some disappointment. So on the budget day, now this is not again trying to say that you cut down on your exposures or make short calls, etc. We do not advise any of those things. But we might see a correction around budget day. Because if the expectations are not met, then we are likely to see probably some correction because, as I said, it is driven by emotions that drive the liquidity. Post-budget, markets are likely to be flattish. You will not see sharp ups and downs, mainly because big bang announcements may not happen immediately thereafter. However, again, very boring to repeat that our expectation that the long-term India growth story will continue to be in play, with India attracting more global capital. Currently, just about 2% of global money is invested in India. For all the FII, FDI that we are talking of, etc., just 2% of global money is what has been invested in India. This is a very, very small number for a country of our size and with the kind of growth that it is experiencing.
And we are contributing to 7% of global GDP growth.
Correct. So contrast this to what Ram said about Japan or what I said about the US economy. Our share in international trade is actually increasing, and the amount of capital that's coming into the economy is actually lower. So what this implies is that a lot more liquidity will flow into India, and that will propel not only our economy but also our markets. So remaining invested and not worrying about the day-to-day ups and downs in the market, which is again, those ups and downs are very important for traders. They have to make money playing on that volatility. But for long-term investors like us, remaining steadily invested in quality stocks is probably our best way of adding to our wealth. So Ram, I think with this, I will close, and maybe if there are questions, I will take. Or you may also answer.
No, we'll straight away go for questions. I think, very interesting point. But can you first start with the point that I made earlier, that the nervousness with respect to the US market market cap contribution vis-a-vis the world. Maybe this whole AI buzz is extending it. But what could be a potential scenario if there's a sharp correction in the US?
Again, economics is very simple. Capital chases returns. So if you see an economy like India growing at very high rates, then a global investor will want to allocate more funds into an economy like India than an economy like US, where the perception is that it's near its peak and there's likelihood of sharp corrections because of its inherent reasons. And therefore, a lot more money can come into not just India, emerging economies, but today, given the position we are in, we are likely to attract far higher allocations.
Yes.
Typically, money coming into India, the fear is of, post devaluation, after taking into account exchange rate fluctuation, the net return, the USD denominated return is not very great. That is what is compared. Because end of the day, for the global investor, that is what matters. But with a stable economy and a lot of money flowing into India, the likelihood of the exchange rate depreciating or devaluing very sharply is very, very minimal, if not non-existent. And therefore, the returns for someone investing in India, a global investor investing in India, are likely to be higher. And therefore, if money is coming out of US markets, then there's definitely a very strong possibility of a lot more of this money coming in, finding its way into the Indian markets. So that will be a positive.
The one question came from Raj, or one observation, that is 2% global money invested in India normal vis-a-vis historical data.
See, I would say that it is earlier it was far more lower. Okay, so now we are seeing that a lot more money is coming in and a lot more money is likely to follow. Because imagine an India, the perception of India in the start of the century, around 2000, etc., we were perceived as a poor country with no wherewithal and no infrastructure, a lot of problems, diseases, below poverty, etc. Image of India today has changed. So obviously, an investor is willing to take much more risk with India.
So my take, Raj, is that we could be sitting on a deluge. Given the strong points about India today, the fact that the top 500 companies are likely to see earnings growth 22%, that is, I don't think that kind of growth is there anywhere in the world. Our GDP growth is stable. A lot of fundamental and foundational reforms have taken place. Inflation is tamed, like Manoj told earlier about 20 minutes ago. But more importantly, if you look at inflation volatility, it used to be 2.9% between 2005 and 2014. Now that has come down to 1.5% and is likely to go down further. So between 2015 to 24, it has come down to 1.5% from 2.9%. So businesses have more clarity in terms of what to expect, in terms of interest rates, in terms of the prices of input materials, etc. So planning becomes that much more easier. And the macro things like current deficit, etc., are anyway improving. Exports are improving. Exports are, so all of these, to me, the imbalance of we having so less foreign money compared to how much we are contributing to growth, that will get steadily addressed, and we could see a huge inflow of foreign money into India, which could be a massive tide. The only downside that I would see is that maybe some major geopolitical events playing out. But that would be, I think, something nobody can predict when and how it will happen. And even if it happens, our secular trend of growth will continue because we are so underdeveloped. There's so much poverty, so many challenges that we're facing. And now we have the right machinery in place, right intent in place, and earnings are, going up. The numbers that Manoj shared earlier themselves show that, the EPS has multiplied 3 times, right, Manoj?
Yeah, 3 times.
So yeah, are they overvalued? So in a nutshell, are the markets overvalued? The answer is we don't know, frankly. We can definitely say that compared to 5 years down the line, they are probably undervalued. But aaj kya dikh raha hai, today, how much is it there? These are all temporary things. As a long-term investor, I would, keep my equity allocation pretty high. And of course, within our liquidity, safety, and growth framework, if the liquidity and safety needs are met for most of us on the call, I'm assuming they would largely be met. So the allocation to growth, which is equity, can be substantial, resulting in substantially more wealth creation, resulting in having a great life for not only us but for everybody around us. Okay, I am seeing a couple of more messages. Let me read out. Sanjay Chakrabarti, what are the sectors which got this foreign money invested in, and what are the sectors that could attract the deluge if there is a US correction? That's his question.
Okay, so my hunch would be that we will see a lot more investment into manufacturing sector, given the effort that is being made to enhance our infrastructure and give fillip to the manufacturer. See, if you see the history of India, we've always lagged in the manufacturing sector. Earlier, we were predominantly agricultural driven, and over the last 2 or 3 decades, we've been service sector driven. Today, services contribute the maximum to our GDP. But what has lagged all along is manufacturing. And that is where, a lot of action is likely to happen. Even the foreign direct investment that is coming in recent years is in respect of setting up manufacturing facilities. So going forward, I see a lot more capital inflow coming into manufacturing. But again, based on which kind of companies look for what kind of benefits, you will probably attract money in the services sector as well as agriculture. So while if I have to choose one, I would choose manufacturing, but I think even agriculture and services are likely to attract a fair amount of capital.
See, just to add, most of the foreign money, Sanjay, would come into large companies. Sectorally, information technology they're familiar with. So the foreign holdings in companies like Infosys, TCS is especially Infosys is pretty high. So they have good exposure to those companies because they are daily dealing with those companies as end customers. And as you know, IT industry ka penetration into the global BFSI industry is pretty large. So that would be the easy answer there. In addition, they look at, for example, automobiles, biggest consumption items. So Tata Motors, Maruti, M&M, they'll have good exposure. Pharma, again, large companies. Financial services, all the big banks, HDFC, ICICI, SBI, Axis have good exposures. Then there are these e-commerce companies which have come up, right? I mean, Flipkart is practically owned by Walmart now. So you could say that there's a huge Walmart investment in Flipkart. And so all these new age companies, they would definitely have good exposure, either as VCs and which then became public holding as the companies went IPO. Then they want exposure to infra. So you could say all the key sectors there is exposure, but the numbers are less, and they could only become big over time, which again means that there will be these companies will have huge access to funds and expand, when the deluge comes through. Okay, any other thoughts? Any other questions? You can verbally ask it also. I've just turned the unmute option for everyone. You may ask verbally also if you have any thought or question. So, so Raj has summed up nicely in the chat. He's saying long-term investors stay invested. Yeah. Yeah. Not only that, if like Manoj said, there is an opportunity post budget, then probably increase your equity allocation. That is also another way to look at it.
I guess if there are no questions, then we can close the call now.
Yeah. Thank you, Paridaji. Paridaji says useful session. So is Raj. So thank you. Look forward to again catching up sometime in early or mid-August. Like I said, we intend to do this on a monthly basis. So do share your feedback. There is a link that Kumar has posted on the chat window. We'll also send this across to you separately. Please, share your feedback in the form. Thank you. Thank you, Sanjay, for that message. One question from, I don't know his can you please tell us your names? The name reads the mobile phone